All right, it's 8 p.m. We'll get started. Thanks everyone who is joining me live and or watching it later in on one of my channels. So for those who are not familiar who I am, my name is Deriama and I'm a financial advisor. I'm based in Shanghai, China. And I've been living there for 14 years now. And right now I'm in Russia, St. Petersburg, visiting my family. So that's why it's still daytime here. And so I'm based in Shanghai and I work with expats and their families and help them build their financial future while they're in China and beyond. I work under a company called Divya Group. So we're a team of financial advisors in China, but it's an international firm with offices in a lot of different countries. Along with that, I run my own channel with financial education content called Moneyed Expat. So I have a channel in YouTube, channels, and other social medias, and also I have a podcast. So if you're new to Minded Expat, feel free to look it up or contact me. I've recorded a couple of podcasts on very interesting topics so far, and so if you want to learn more, you can just contact me or look me up on YouTube at Minded Expat. Hmm. So recently, I believe it was a couple of months ago now, I made a video about social insurance, and there were a lot of questions and many of them were about the basics of the social insurance, so how it works, how to check if I have it, and I'm not sure if I have it, uh, and a few more other questions. And also there was a number of questions around, but my employer doesn't pay it, so what now? What happens? What are my options, etc. So because of that, I've decided to do a webinar where I cover what's included in social insurance, who gets it, who qualifies, and more specifically on the pension part, right? So I didn't dive much into other aspects of the insurance, but there is information about that as well. And so being being more focused on pension side of the social insurance, we'll also discuss, so what are other things that you could do if you do have the social insurance or don't, right? So we'll touch a bit on that. And so also we will touch a bit on this other thing called planning for retirement, right? Because for me personally, I think for a lot of expats, one of the most difficult things is just understanding how much we need to save for retirement and how much we might need to have a comfortable living, right? So it's not just the survival mode, because in a lot of countries, it is set in a way that we are sort of having a basic minimum for our retirement. And so making sure that you have a comfortable amount that can support you is more important, right? So we will touch on that. So without further ado, I will start my slides. If you have any questions at any point, you can message here. So drop your questions below. So, and then we'll have a bit of a Q&A after I finish all my slides. Hopefully it won't be too long. All right, so let's see. Second. I also prepared an Excel calculator that we usually use for calculating what kind of pension we might need. So we'll touch a little bit on that as well later. So before I crack on, a quick disclaimer. I don't work with the social insurance. I don't have any secret connections at the Social Insurance Bureau. All of the information I'm sharing today is all available online. So these are English articles, English language articles that are available, and you can all look them up yourself as well. And there might be some specific situations, right? More unique scenarios, unique cases. In that case, you can reach out to your HR because they are the ones working on your employment, on your enrollment with your current company. So the direct conversation with the HR department, or you can also go to your local social insurance bureau. So every district has one. Now, whether or not they speak English is a different thing, but in any case, you can always grab someone to go with you or use a translator. That also works. And remember, this webinar is for educational purposes. For any kind of more specific cases, uh, consultation, more specific strategies for your personal situation, reach out for a consultation directly, right? Because every person's individual background situation is different. So that's why it's best that you have a chat with a financial advisor before you make any decisions. All right. So how social insurance works in China. So first of all, it's a combination of 5 different insurances and one fund, right? So within these 5 insurances, we have a pension. So part of your contribution to social insurance goes towards pension, another for medical insurance, another goes for unemployment, work-related injury, and maternity. Now, with medical unemployment and injury, there is a certain minimum of years that you need to work to have a higher um, compensation. But in general, so there, as soon as you start working, as soon as you start making contributions for social insurance, they start building up. And then I believe for unemployment, you need to work for at least 3 years before you have that available to you. So again, double check on that. So don't quote me on this because I only checked more deep on this for pension part. Okay, so there's also a common confusion around housing fund. So actually, it's called in Chinese, it's called 5 insurances and a fund. So which is basically 5 insurances, the ones that are mentioned already, and housing fund. And the housing fund is optional. So in some cities, because they're already do it for a company, for example, they're already doing it for all of the employees, so they will just do it for you as well. But actually, it is voluntary for foreigners, so it's not mandatory. And so your company might or might not have that for you. So whether you have it, check with your HR and see if you have that one as well. And I believe that that one can also be withdrawn as if and when you leave China. Now, based on the questions that I was receiving after my video about social insurance, I realized that there were a few things that people don't know, and they think that something else is actually social insurance. So let's review those. So first of all, it's not tax. So just because you're paying taxes doesn't mean you're paying social insurance. A few people would message me, oh, I worked in China in that year and I was paying taxes. I'm not sure if I have social insurance, if it's still active, etc. So taxes is one thing and social insurance is another thing. Remember, they work in brackets, so they go from 3% to up to 45%, and which bracket you end up towards throughout the year depends on your income. So the higher you earn, the higher the taxes, especially towards end of the year. And with social insurance, it's another contribution that you make, so after taxes, right? So they go at the same time as your taxes, and so it's a different thing. So they're not the same. Another thing is that it's not a private pension. So there is an enterprise annuity, and it's a private pension plan offered by usually large corporations to their employees as a perk, right, as a benefit, and but it's voluntary. So it really depends on the employer whether or not they can or want to offer something like this to their employees. And another thing is that that private pension plan works slightly different than the state social insurance because it's voluntary, and also the taxation on that plan might be different. So if you have something like that, check with your employer how it works and get more information, and you might have more flexibility on it. But social insurance is different. And the medical insurance part of it is medical insurance, but it's not like a direct billing insurance that some of us might be used to, right? So you might go to a hospital, and if it's not linked to your sort of a network, linked to your eBOW, then you might need to pay yourself out of the pocket and then do a claim separately. And also, depending on your case, you might have to um, apply for a coverage, and it might not cover the full amount of your treatment. So it is case by case, and you will need to check if you have eBOW, you will need to check what kind of hospitals you can go and check where is the nearest one. So you can go there and get your treatment and yeah, just cover the difference if that works for you, right? So I think for most expats, it's okay to kind of pay and then wait for the claim back, but it's up to you. So I do recommend just checking if you have eBOW, where is the nearest hospital you can use, and just know how it works for you personally. All right. So who qualifies, right? So first of all, it is for legally employed foreigners who have the work permit and Z visa. If you are on a business visa and are a freelancer doing extra classes on the side, you don't qualify. If you're a student, also have a side gig, and you're on a student visa, then you don't qualify. So you will need to work with a company or a specific employer who will be doing these contributions, who will enroll you and make the contributions along with you. And technically, the employer, once you start working, right, you get your work permit, and they need to enroll you right away as soon as you start. So now the pension part, right? So the requirements for the to receive the state pension from the social insurance is, yeah, the age, right? For men, it's 60. For women, it's 50 or 55, depending. So white collar jobs are 55 and blue collar jobs are 50. Now in China, the age for retirement is also being increased every now and then. So by the time we get there, it's probably most likely it will be higher than this. But for now, it is 60, 50, and 55. At the moment, as of 2026, you will need to make contributions for 15 full years, and that number is increasing to 20 in 4 years. So for someone who's made contributions for 10 plus years, there's a chance that they might be okay with 15. But for others, especially those who are, already paying into it, they will just need to make the extra contributions for extra 5 years after 2030. I didn't find any information about tiers. If you've already been paying for 10 plus years, it doesn't look like you get still 15 years or something in between. It's just going to be plain 20 years if you haven't paid 15 by 2030. right? So just keep in mind if you are a younger professional who's been paying for 5 or 10 years, uh, just add 5 more years to your contributions. At that, that's that. Okay. So what if you leave China, if you've paid, let's say, 5 or 10 years, you can withdraw your part of the contributions that were made into social insurance. You go to the bureau, you apply, they will need to check your account, how much you have there, and you can do a withdrawal, and that money in cash arrives to your bank account, which you can uh, transfer wherever else, right? Especially if you're leaving China, then you're going to probably withdraw to your home country bank account. If you left and then came back, your contributions just resume. Especially if you were paying social insurance before and then you leave, you come back, and you're again in the social insurance scheme, then your payments just continue, and so they just, despite the break, they will just carry on. So they don't get invalid or null after your break. And same if you didn't leave the country, right? Maybe you had a career break, maternity leave, education, or something like that. You didn't work for a few years. You can just continue again once you start working and have, again, social insurance. When you don't get life social insurance. So if you didn't pay full 15 or 20 years soon, then you don't qualify, right? If you paid, let's say 13 or 14 and a half years so far, but didn't reach that full amount of 15 years by now and 20 in the future, then that's it. And also, if you're 60, but you weren't able to pay for full 20 years by the age of 60, that's it. So you can withdraw what you have contributed, but you cannot continue paying into social insurance. So it's, for example, if you're 50 years old and you're just now getting registered into the system, and uh, but you're not gonna make 20 years of contributions because you only have 10. So therefore, you can make contributions for 10 years and then withdraw what you have contributed at that point, and then invest it elsewhere, or use for other expenses, etc. So once you hit 60, that's it. So social insurance starts paying pension funds if you made the 15 or 20 years of contributions. And if you didn't, then that's it, no pension. You can technically you can make contributions retroactively, but that is something that you will need to have a conversation with your employer whether or not they agree, because as some of you might know, employers pay more than their employees. So it's usually double, depending on the province. But if you're paying 10%, then your employer is paying 20%. So that will be a difficult conversation with your employer, and I doubt that a lot of companies will be on board with that. But who knows, right? You can always have a conversation and negotiate and see if it's possible at all. All right. Next on. Oh, yeah. And then there are a few countries like Germany, for example, they're exempt from the social insurance because they have their own. So whether or not your country is also exempt from social insurance, you will need to check. You can just Google it. It's a pretty public information. So check if your country is also exempt. But if not, then you're technically obliged to be part of the social insurance. Now, how do we check whether or not we have it, and what is the record and what's the balance, etc. So the easiest way is through your HR because they are the ones handling your enrollment, and so they should know whether, at least whether or not you have it. So you can ask them, just confirm yes or no. And after you have the confirmation, yes, you have it, then you can just go on the website, just search Shibao. And uh, again, these Shibao, they're different for different provinces. For example, the one in Beijing is a bit different from the one in Shanghai. So best you check or ask AI, right? So what is the social insurance portal for my city, for my province? And Yang Lao Jin is the pension part of the social insurance, which you can see on the website, or just if you have someone who speaks Chinese, they can help you. Okay, and in person as well, you can go with your passport to the local bureau and they can look up and print your records if you want to. And then since a couple of years ago, we now have the app. So in the app, it's the same information. You can log in, but I believe you will need to do a certain registration process. I don't really remember what was the process because it was 2 years ago, but your HR should know about it. And you probably also have one too, because it was required for everyone to have the digital one a couple of years ago. But yeah, do check with your HR how to log in and register on that one. Okay, so based on the video that I mentioned before, a lot of people said, I don't have it because, no one in my university has it, or they said something. And so the reality is that some of the companies, they say, oh, like it's in the process, or we forgot, or something like that. But the most common workaround is the private health insurance. So a lot of employers, they when they're setting up the paperwork, I assume that there is a box where you add either go with social insurance, or maybe there's something like a box for private health insurance. Because technically, within these five social insurances, there is a medical one. So if they are providing a medical health insurance, then that service is provided for. And so a lot of expats will have um, hmm, a private health insurance by a broker, and so and because they have that, so they don't have the social insurance. And based on what I'm seeing online, the comments and also other videos that I'm seeing from different people, the most common comments were, oh, you should report them, get them audited, or force them, etc. And well, whether you do this or not, what you decide to do is your business, right? So you're an adult and it's up to you what you want to do with the situation, but at least you should know what you're fighting for, right? So we'll review the numbers and see if it's really the thing that worth fighting for. And because if you're this is not a light decision to make. And you should understand that if you do report your employer, then there will be a full-on investigation. In China, these things are taken seriously. And if they do force everyone to pay, then you and your colleagues will be affected as well. So it's something just to, consider before you make any decisions about this. And I'm not a legal advisor, so I'm certainly not saying that you should do any of these things. I'm here to just provide information on how the social insurance works and what you should expect when you're making the contributions and what is the alternative, right? If you don't have it and if you are not going to do any of these things, and therefore you want to take care of your pension yourself separately. All right. So let's look at the numbers. Again, this is very public information. This formula, how it's calculated, It is available on one of the websites, which I will share in a bit. So essentially, it's local average salary, right? So, and not expat salary. So let's be clear on that. It's a local average salary of a average person in a Chinese city. So, and a local average will be different in every province and even a different city. So, average salary in Shanghai will be much higher than, let's say, in Shenyang, for example, or city like Guangzhou, or even smaller village, right? So, every province, every city will have their own average salary. So, if you're working in one city, the average salary will be different from another. And then your index salary is your salary divided by two, plus the years worked, and also your individual account, right? So once you've made certain number of years of contributions, then you will have a certain balance in your personal account. So that also gets accounted for when calculating the pension. So what we're looking at, for example, right? Again, it's taken from an article online. Let's say we take someone who made 20 years of contributions. Their personal account balance is a 200,000. And because they lived in, I believe the article was around Beijing or tier one city. So the average salary was, uh, I believe, 2,000 something RMB. And so the salary is 3,600 RMB. So you can use this basic pension with your own numbers, right? Especially when you know your salary and average salary as well in wherever you are. And so you can calculate just on average how much you might receive, right? And more information you can also get from this article, Pension in China, and there are some calculations provided. So this is just a reference, right? Because the salaries will be different for different people. And as I mentioned, it will depend where you are in China. But yeah, 3,600, it's not that high. And I think realistically, it won't be enough for a comfortable living, to be fair. All right. Another thing is that we need to understand that in China, these pension funds, there is no investment involved there, right? So it's not like a pension fund, a pension plan in your home country where you can choose an investment fund within and choose a different higher growing fund or something like that. No. So it's all based on so how they make the decision on whether or not to invest that, and you don't even know if it's invested. In fact, I didn't find any information whether or not they invested. Maybe not. Maybe fixed deposits or something very low risk, but you have no say where that money is kept. It is adjusted with inflation, but as you know, in China, for the last quite a few years, the inflation is quite low, and therefore the basic salary is it just stays there. Over time, they might increase it if inflation goes up, but it is based on the minimum salary. So minimum salary is someone who's working, for example, a Chinese teacher in a school, or a Chinese worker in an office, or someone who works in the subway, right? So that minimum is set up by the government for an average worker in whichever city. So expat salaries, they are not accounted for in any of these formulas or calculations. And so based on the number that we saw in the previous slide, it's not huge. And which is not surprising because I think in most countries in around the world, pension is not designed to give you a very comfortable living, right? It's enough to have a living, but whether or not it will be enough for you to have a nicer apartment or travel or go somewhere abroad or buy things that might be, slightly more expensive than average, it's not something that's common, for people who retired. So we just need to be mindful that state pension is not something you should depend on in any case. And so if you have the social insurance and if you want to see how much how much you can expect from a state pension, great, right? So if you have some kind of income coming from this social insurance in the future, that's great. Happy days, just extra income. But if you don't have it, I feel like it's not a life-changing amount, and there are other ways to set something separately for yourself that might grow and give you some maybe higher income. But we'll touch on that in a bit later. Okay, also consider so these pensions for those who qualify and so when you reach that time, when you're 60 years old or 55, you apply for a pension, right? You're here in China, for example, and then you're applying for a pension. Remember that this pension will need to be paid to a Chinese bank. So, which means that you will need to have some ties with China. You will need to keep your account active so that you can receive. So, they will not PayPal or WeChat transfer to you or use any other international or Wise, for example. They won't be doing that. So, it will be just arriving to your Chinese bank account. And so, UnionPay. Personally, I've had situations where my UnionPay didn't work abroad, um, but in some countries it does work, right? So it depends where you are at the time. So I think that you will still need to have some kind of ties with China or be willing to come to China every now and then to access those funds, maybe transfer them out, or mm, yeah, take the cash, for example, or something like that, right? So this is if you are receiving the pension. So, but if you don't have it, don't have the social insurance, that's okay. That's fine because again, there are other solutions. So if you do have it, but you don't plan to live in China, then you can withdraw the amount, invest it elsewhere. And if you don't, it's okay, right? You can take use some of the surplus that you're not spending right now in China and then have it invested for the amount of years that you want and potentially have higher growth than a pension would. So this is in my opinion, right? I believe that social insurance might work best for expats with Chinese spouses, with kids, because as I mentioned, you will need to have your bank account active in China. You can leave but then come back. So it is best if you have some kind of ties with China and, especially a family member. Those with, businesses running in China and permanent residence card, because when you have a PR, the requirement is still that you spend at least 3 months a year in China anyway. So those with PRs or who have business and can apply for a visa, because the plan is to stay in China anyway, right? Or come every now and then, it works. So it's not an inconvenience to schedule a trip to China every year, let's say, to just get some money. Yeah, so it depends on the personal situation, but for those who will be in China anyway, then it works. And then for people who intend to retire in China, if there are means to stay legally with a PR or a visa or something like that, right now, as of 2026, there's no specific retirement visa, but those with spouses or maybe specific invitations, there are different ways to stay in China long term, so which you can also look up and explore. and see how that goes, right? And yeah, and if you are planning to spend your retirement here and have the social insurance, so yeah, why not keep it and have it running and have even if a few thousand RMB as part of your pension. So, but if none of this sounds like you, right? If you're an expat, your partner is an expat, and you're planning to move to another country and live there, or retire in your home country, then it's fine. Just withdraw if you have the social insurance, withdraw whatever your contributions are when you're leaving China and withdraw, invest that money elsewhere. You can set up a bank transfer with Wise or through the bank. Some tax documents and the declaration from the office, from the Social Insurance Bureau will be required. But as far as I know, there are no issues transferring that amount out of China. Okay, so let's talk about alternatives, right? For those who don't have a social insurance and those who realize that it's not going to be a lot of money or enough for a comfortable lifestyle that you're used to, so you can work with a financial advisor to make sure that you have savings enough to have a good living after you retire. So it could be at 60, could be 65, could be 55. And the beauty of it is you decide. So when you have enough savings, you can decide whether or not you want to work, whether or not you want to have that more flexibility, take part-time job or maybe just projects here and there, but then you have your own saving spot that supports you financially and any other income is is welcome, but it's not critical for your survival. All right. So with a financial advisor, the flexibility is one of the keys because you don't need to wait for the state to set up when you get to retire or not, right? So you decide. If it's a bit sooner than 60, great, happy days. If not, then it's fine. And you just work, right? You decide when you start withdrawing your own funds. Frequency and amount, you decide again. So we'll touch a bit on the calculator, how much we should be investing towards retirement. That really depends, right? Because we all have our own personal, say, situations. So you can uh, decide if you want to save more to have more money by the time you retire. So it's all up to you. Now, professional guidance, of course, we financial advisors, we do the research, we check the news, what's happening in the world. And a lot of my conversations as a financial advisor are about what's happening in the world, why markets are down or why are they up, and should we do anything to take advantage of the current situation. And fees, of course, financial advisors, just like any other professionals, don't work for free. So fees are applied, but how much really depends on who you're working with and what you're doing. Uh, but this information is something that's, it should be transparent. So you should know if you're working with a financial advisor how much you're paying for what. Okay. Another thing is the access to funds and ETFs, also stocks and other assets, etc. So I'm just adding funds and ETFs because they are typically the ones that are core of a retirement portfolio. Hmm. And smaller monthly contributions. By smaller, I mean, just a couple of $100 as a starter point is possible. So it's not like you have to have $10,000 every month to start investing with a financial advisor. Not at all. So much smaller amounts are okay. And especially if you're someone in your late 20s, early 30s, it is definitely okay to start with just $300 a month because you have longer time towards until retirement, right? So you have more years to save. So if it's someone, if you are the one who's starting your journey right now, even a couple of $100 is enough, and it's gonna make a big difference over a few decades. Now, if you're someone older, say your mid 40s, 50s, then of course, because we have shorter time, I think $300 or $400 won't do it, but again, something to discuss with your advisor. And there are different strategies and different ways. Perhaps you might have some time, maybe retire not at 60%, but later. But the thing is, it's all discussable, and you will have a few different options to work with. Now, another option is do it yourself, DIY, also possible. Same thing, you have flexibility. You can choose what you invest, for how long, and the frequency, right? Most of the international platforms from China can be funded from a Chinese bank. You will need to do the research yourself, right? Because it's do it yourself. So you will need to look up what kind of investments, what kind of stocks or funds you want to invest into, and you need to have an understanding um, which ones match your risk profile and your goals. And also, over time, we do need to do rebalancing because our risk profiles change, etc. So that is something that you will need to do yourself. It's absolutely possible. So you will just need to have the time and perhaps some patience and dedication, right? So because with these things, consistency is one of the most important things. Fees apply as well. Of course, DIY platforms will be slightly cheaper, um, but nothing is free, right? So you're still paying for the servicing on your platform, and also there will be dealing fees, etc. So they're not free, but most likely it's cheaper than having a financial advisor. You also have access to funds, ETFs, stocks, and other. So uh, probably you will need to check which kind of assets you want to add to your portfolio, but all of those are available on most of the platforms. And same, you can also start a regular contribution strategy. Look up unit cost averaging or dollar cost averaging strategies. They work for someone who's, let's say, busy with work and aren't able to make a lot of trading on a daily basis. So if you are able to make a transfer once a month, just look up unit cost averaging, and you can make an automated investments on these platforms, and you can just continue investing. Hmm. So quickly on these, so a simple starter portfolio, right? So this is something that we might start for someone who's just new and unsure where to start. And so we will typically have an ETF that follows a global index like global MSCI or maybe S&P 500. So with ETFs, the beauty of it is that they are low cost. Typically, it's 0.5% or even less per year, and they just follow the index. One of the cons of these ETFs is that they just follow the index. If the index goes down, then your portfolio might go down in value as well. But as long as you don't sell, you're good, right? Just wait it out. Don't panic sell if your investments are down in value. Another thing is actively managed funds, typically also provided by big companies. And usually they will have a team of people, fund managers, and researchers and analysts. So these are the people whose 9 to 5 is research companies, check their balances and their performance, and whether or not to keep them in the fund or add them to the fund or remove them from the fund. And usually they will be themed. So some of them might be themed on semiconductors or AI or just global companies, right? So as an example, Divam Global Equity Focus, it's one of the funds that we work with. And so it invests in large companies like Nvidia, Netflix, Apple, etc. Right? So large companies that are everywhere and they grow consistently. And other assets. So it might be, yeah, structured notes is a product that we offer to DVR clients. I don't believe that they're offered in other platforms. So these are the assets that pay coupons. Not like bonds, but the idea is very similar. So if you want to learn a bit more on structured notes, you can reach out to me. But along with structured notes, we might also add something like gold or maybe more niche, more focused funds that are focused on a specific industry or specific sector, like energy, for instance, or precious metals, right? So we're not overly focused on one thing with precious metals, for example. We're not just going for gold, we're going for a basket of different precious metals. Um, sure, it won't grow as at the same level as one of them would, but we have diversification, and in some situation, diversification is more important. Okay? So the best is to have that mix of these three in a portfolio, and this is something that we usually build over time. So when I'm having conversations with my clients, I would typically have one or two actively managed funds, maybe one or two ETFs. And over time, when the portfolio is growing, then we might start adding extra assets like structured notes and commodities. And the most important thing is having it consistently. So every now and then, every half a year, we meet up, or every once a year, we meet up, we review the funds, the portfolio, how it's going so far, if we need to change anything, if we need to add anything. And yeah, so when the markets are down, and they do quite often, at least once a year, we have some kind of situation where the stock markets react, they go down. And typically, the conversations I have during this time is that it's time to take an opportunity and invest more because it's a really good buying chance for investors. Okay, so now let me change the topic, change the screen, right? What we, again, quickly, right? I need to be mindful of time. Uh, how much do we need for retirement, right? So if, for example, if someone doesn't have the social insurance, so they're thinking, okay, how much do I need for retirement? And I think among expats, it's the biggest question typically because I don't know how much I might need. And for us to determine what's the retirement savings pot should be, we will need to know, okay, how much you want to receive, right? It doesn't have to be a specifically one amount, but, desired, right? So what you might think right now, of course, that number might change later on, but then later you will adjust your strategy. How much do you think now you might need? Then expected retirement, in retirement, or again, roughly, we don't know, right? We don't know how many years someone will live, but we will kind of calculate, okay, so maybe we will live until 90 or 95, maybe less, maybe more, hopefully, who knows? Then inflation. So many people overlook inflation because it's something that goes on, consistently, and in a short period of time, it's not as noticeable. But if we are looking at longer years, then it has a big impact, actually. And estimated growth rate is what we are expecting for uh, our investments to grow over time. So I'm going to change the screen. Hopefully you guys see it. So this is uh, a retirement calculator. Let's say someone 40 years old, they want to retire at 60, inflation rate 3%. So inflation goes up and down, and most central banks aim for 2%, but in reality, it doesn't stay at 2% for too long. It tends to go higher or lower over time. So let's say if we're using RMB for reference, but actually it can be, I don't know, $2,000, let's say. Or $2,000 is about 1,700, oh, 1,700 euro, or it could be 1,800 pounds, right? So it's just a calculator. It's not really rocket science here. It's really um, for reference. And so this is something that we need to be mindful. But let's say 1,200 RMB. This is an example. And so what I might need in 20 years, right? By the time we're 60, so a little over 5 million RMB. And now this is including the inflation of 3%, so actually it's 2.8. So if we were someone who's just taking 5% of growth of this amount, this is 12,000 in today's terms. Now, I realize that it might be something not super clear. For that, I do recommend that you have a consultation with me or another financial advisor, where we can review, okay, so how much you might need and how much inflation we're talking about. So 3% is just global average, but let's say if I'm from a country where inflation is higher than, of course, for instance, 5%, then of course I will need more money to buy the same amount of goods and services in 20 years because the prices are going up with slightly faster pace than in some other country, right? So inflation is different in different cities. For example, in China, as I mentioned before, it's a bit slower. It's about 1 point something percent as of 2026, but it might go up soon because oil went up in price. But we'll see, right? So the inflation is not something we can control. It's something we can just anticipate and prepare for. So there you go. For example, yeah, so we're looking at, let me change back to 3% because that number is too scary. So we have at 5 million RMB. So if I'm 40 years old, and then we're looking at, okay, to retire at 60, and so how much per month I might be able to save right now with my current savings rate. So for instance, 5,000 RMB. So at 6%, it's something, again, risk profile is very different for different people. But let's say we take it at a modest rate, 6%, then there you go. So if I was saving just 5,000 RMB, I'm most likely, again, this is for reference only. We're not accounting for fees or taxes here. So it's just the growth, right? So 44%. So I will share this calculator with you guys, those who registered for the webinar. And then so you can also play with it, see if, how your own numbers work with this one. And if you want to kind of have an explanation step by step, I can also do that for you. All right, so going back to my to my slides. Next thing is taxes, right? So also a very important thing to remember. And I checked this. So social insurance withdrawals in China are not taxed. So whether you are receiving the pension or just taking a withdrawal when you're leaving, it won't be taxed. But you may need to do the filing in your home country. So this is something you need to check with the tax requirements in your home country. So something to be mindful of. And if you are someone who is investing separately yourself on an investment platform or with a financial advisor, because it's a personal pension, right? It's not even a pension, it's a personal investment plan, an investment account. So when you are making withdrawals, it is considered as realizing your gains, and therefore it will be a tax event. But in quite a lot of countries, it is possible to do a strategy where it can be deferred. Again, something to discuss with a financial advisor because most of those products won't be available on investment platforms, but through institutions. And in China, for example, there is a 6-year rule on taxes, where expats are exempt from their global income, so including withdrawals from an investment platform, so long as they are within the 6 year rule, as in they left China for more than 30 days within 6 years. Now, this current 6 year rule is until 2027, end of 2027. So we will see whether or not they will extend this policy, or maybe they will make any changes, maybe make it shorter or longer. But of course, we will cover that when we get there. Okay, so key takeaways. So if you are making contributions into social insurance and you're planning to stay in China, as in retire here, you have a Chinese spouse and kids, or you have a PR and your business is in China, so your future is really tied to China, then keep it, and just when you get there, just receive the payments. If you have it but don't plan to be in China long term, then you can withdraw it by the time you leave and invest that amount somewhere else. If you don't have it and you don't plan to stay, then start saving yourself, uh, or with the advisor. Especially with the advisor, there are options that are global, right? So you will need to be mindful of opening an investment platform in China and whether or not it might work where you are planning to move, because in some countries, uh, you cannot invest in certain platforms. For example, crypto platforms. So they're accepted in some countries and they're not accepted in other countries. So something to be mindful of. Okay, in any case, remember that, state pension is not something to really depend and fully rely with your future, because, the reality that we're living in right now is that if you want to have a comfortable retirement, a comfortable living, you need to depend on yourself and you need to take care of yourself. Okay. And so it doesn't mean that, you don't need to make any contributions into the state system. So if you can, do it. But if you don't, it's not the end of the world. There are other ways to make sure that you're saving for your future. And yeah, and if that's something I can help you with, feel free to contact me. And if you want to do it yourself, there are lots of resources online, YouTube videos, books, podcasts about personal finance that you can listen to. You can learn. There are books too, and there's just so much information. And yeah, you can definitely learn these things and do it yourself as well. It's just having a financial advisor is just there's someone telling you what to do, versus you learning that yourself. Okay, so if you are not connected with me yet, make sure that uh, you add my WeChat. And if you have any kind of other questions you want to ask me directly, add my WeChat, and I'm happy to answer any questions. So let's see what we have here. So someone asked me, what's the definition? Your contributions as opposed to employer's contributions. Right. So my contributions is what I pay into social insurance. So there is a part, social insurance, right? So there is one part that I pay as the employee, and the bigger part is the employer. So they need to match what you have, and then they add on top. So from my understanding is double, right? So if I'm paying 10%, then the employer is actually matching and adding on top another 10. So actually they're paying 20%. It's different in different provinces and different cities. So you will need to check how much exactly your employer is adding versus your own contributions. Okay. Another is I already left China. Okay. So checking your contributions if you already left China. Uh, I would say, yeah, check just to confirm whether you had it or not. If you have connections with your HR, if you are still in touch, you can ask with them. Um, Likely, if you worked legally in China, you probably had the social insurance anything related with social insurance, in which case you can just, because your work permit is linked to social insurance in a way, so you can go on the website and see if you can log in there with your passport or work permit if you still have the information. So try checking online if it's available. And next time, if you ever come back to China, just visit the local bureau in person. And withdrawing needs to be done while you're in China. So next time you visit Shanghai, or okay, I'm not sure which city you were in, but when you're back in China, then you can check with the Social Security Bureau and apply for withdrawal. So it needs to be done in person. Okay, when you work with clients and offer commodities, is it physical gold or metal? Yeah, so with clients, for expats, I usually recommend going for ETFs that are backed by physical gold, right? So it's an institution that buys the gold and then they take pooled investments from the investors. Some people prefer physical gold. Nothing wrong about that. I just feel that it's not very convenient when you're leaving China because you will need to have all the uh, documents for each piece of gold that you bought. There is a limit for 50 grams that you can leave without declaring. But if it's more than 50 grams, that you will need to have all the documents to prove that they are indeed yours, right? So it's just extra paperwork. And I think when we're leaving one country, going to another, you already have so many things. I think it's just more convenient to do online. But I can understand if someone prefers to have physical gold. Okay, next question. If I withdraw my social insurance from China, can I work? Yes, of course. You can withdraw your contributions, leave, and then something changed, you come back, and then they will add you again into the system. But then in that case, your contributions start again from zero. So you're just starting anew, which is fine. You know, it's you withdrew. You just make sure that you have those savings. You know, invest somewhere. Um, Again, it depends on the amount, right? For some people told me that they did withdraw and actually the amount was nothing to write home about. So it depends what your income was like when you were in China when you withdrew. But my recommendation is, you know, when you have that extra cash, make those savings work for you, invest them somewhere else. All right. And if I had another question from Tanya, if I had different employers in different cities, should I visit social insurance in every? Yeah, so social insurance bureaus, they do differ in different cities. So the regulations differ. And I think these days the information is quite digitalized. So very likely that where you are now, they have um, access to the information you had about your social insurance from another city. But to be fair, I wouldn't be surprised if they tell you go to that city where you were before to get any kind of other information, because it is different in different cities. But where I would start is just go visit your local bureau first and see if they can provide more information. Typically, um, I haven't heard any issues from any people who were leaving China and they were taking withdrawals because it's still one system. It's just there are slight differences between provinces and provinces. But you can start with just visiting one local where you are right now without, you know, visiting and see what they say first. Okay, and there was something else here, Q&A. What is the rate of interest that the government pays and is it compounded? No, so there is no interest of whatever government is paying, right? As we looked into the calculations, it is based on minimal wage in the city or province where you are living, right? And so it's not compounded in the sense that there is some kind of investment growth there. Um, It can compound if you are, receiving a pension, you're not touching it, and then another one, another one, another one, but there is no investment growth there, so it's not really compounding in the investment sense. Can we withdraw the social insurance only when we leave for China for good? Or can we? Yeah, so you can withdraw it once your work permit is canceled, right? So when that work permit is canceled, then you go to the social bureau to apply for the withdrawal. And what it means that if you are opening your own business, your work permit, what happens to it? Are you opening a new one as a new business owner, and therefore, changing visa and everything? Or are you uh, using the same work permit? Because when you're opening a new business, you're still kind of employed in your business, right? So check what's your situation. And if you are canceling your work permit, then of course you can apply for withdrawal and use that money. Okay, and another question, and one city has only one social bureau. Um, no, so Social Security Bureau, it's per district, just like Tax Bureau or Visa Exit Entry Bureau. So they will have a bureau in every district. So it's just that some of them might have limited uh, access, so they might not be able to do, for example, withdrawals. So from my understanding, in Shanghai, you will need to go to a central one in Pudong somewhere to do the withdrawal as an expat. So you will need to check in your area what your local one can do or cannot do. And so certain things like withdrawals can only be done from a central one. Okay, I believe these are all the questions. I hope I answered all of them. If I didn't, don't hesitate to reach out to me through WeChat or other social media. So I'm very active on all of them. And thank you all for joining today. We ran a bit over time, but yeah, the topic is hefty. So hopefully it was all useful. And I'll be in touch with all of you who registered with the recording link and the Excel calculator that I used earlier. So you can try it, play with it, and yeah, I'll be doing another webinars in the future. If you believe that there is one topic that I should cover, just let me know and I'll see what I can do. Thanks for your time all, and until next time. Bye bye.